Yardena, we good?
Yes, I see you all. You want me to share? You tell me when to start sharing.
Give me a sec to welcome everyone, then you can start the presentation.
Okay.
So, thank you, everyone, and thank you for joining this webinar. I think this is Pioneer's sixth webinar since the virus started. We've received a lot of positive feedback, and we hope that you'll enjoy this one. A special welcome to our overseas participants. I know there's some people online from South Africa, some of whom I know, and special welcome. And we acknowledge that the optimism that you may feel from Israel in terms of this positioning of the virus may not yet be felt in South Africa. So we understand that, and we're with you, and we hope that your numbers improve soon like Israel's have. This call is being broadcast live on Facebook. There's a 30-second delay, but other than that, it's live. And it will probably be recorded and will be available on Facebook on Pioneer's page. So if you enjoyed it, if you find any value in sharing it with anyone, please feel free to do that. At any time, you can post a question via the chat mechanism at the bottom. You can pose the question so that everyone can see it, or you can send it only to the panelists. Whatever you like. We'll try to get to the questions at the end. The agenda for today is hedging against the loss of time. And what we're going to do is I'm going to give a little bit of a macro view, a little bit of where we're at in the markets and how we're positioning our portfolios. And then David Tamir, who I'll introduce in a second, will talk about structured notes as part of the strategy. David, I've known David for about 16 years. He used to work in Pioneer, left Pioneer about 11 years ago, I think, and to set up his structured note business. He's the founder and chief investment officer of Oasis Structured Notes. Some of you on the call who I recognize already have Oasis products in your portfolios. You've heard me try to convince you in the value of structured notes, and some of you hold the product, so you have a nice opportunity now to meet the financial engineer behind those products. Okay, Yardena, please start the presentation. Oops, no, not that one. Yardena. Yardena.
Yes, just a second.
Okay.
No. Wait. Just a second. Technical things.
I'll start anyway. So the macro environment now, the macro environment now, we have a lot of uncertainty. Yardena, do you want me to share?
No, it's okay. I am just doing it now. Don't worry.
Okay. So we have high levels of uncertainty and somewhat of a data vacuum. I think everybody understands the high level of uncertainty. The data vacuum applies to the virus itself, to how long the lockdown will be, how many companies are going to survive and who's going to go bankrupt, how the industries that have been severely impacted are going to recover, which property companies are going to struggle because their tenants aren't paying rent. So there's a lot of unknowns and a lot of uncertainty. Behind that, and because most of the money that we manage is dollars, we have a heavy US market bias, and there's a tremendous amount of government intervention in the US that is helping the situation tremendously, and the numbers are staggering. I did a webinar focused on this issue a while ago. The numbers of the government intervention are staggering. You've seen that in the newspapers, and that is certainly acting as a major counterweight. So the investment question is, would you rather be too early and risk a sort of second sell-off, or would you rather be late, have a bit more comfort and a bit more cautious? So that's a key question. We adopted a more middle of the approach road, where a middle of the road approach where we're cautiously optimistic and defensively positioned. let's just...
You have the controls, by the way. Sorry.
Okay, well, hold on a second. Okay, great, thank you. Okay, so next slide. Right. So the obvious question on everyone's mind, and I've heard this so much, how come the stock markets are not reflecting the collapse of economic activity? Whoops, I jumped ahead. We've got 35 million unemployed in the USA, largest number ever, pretty much. GDP is going to shrink unprecedented numbers quarter on quarter, but the market is not that bad, okay? The NASDAQ is in positive year-to-date, 7%, and you can see the giants, Apple 7.8%, Amazon 31% positive, Facebook 4% positive. The S&P, which is a much broader index, it includes those industries that have been decimated, and it's only minus 7.8%, right? That's not a huge number in the world of equities. The Russell 2000, which is a much even broader index and includes smaller companies, that's down 20%. So that's starting to reflect real pain. But one would think that, you know, looking around at the scale of economic slowdown, one expects even higher numbers, and we just don't see it. High yield bonds down -8%. The rest of the world, FTSE, United Kingdom, down 20%. We've seen the United Kingdom, the extent of the virus and the impact there. Maybe 20 is not enough. Something in, you know, that's a gut feel that 20% is not enough. Euro stocks 22%, despite the fact that there's no central coordination of the types of government intervention that we see in the United States. China only down -4%, and global bonds just are roughly flat. So you can see, and graphically, if we look, go down the slide, why doesn't it go down? There we go. Oops. Okay, so this is year to date. The red line is the NASDAQ, and the blue line is the S&P 500, and the green line is the broad emerging markets. Okay, you can see year to date that NASDAQ is positive, the S&P down 7.8, as I said, and emerging markets down 17.5. So just to let you know, we're Pioneer. We sold our emerging market exposure in late February, and that was a good call. And we started buying NASDAQ in early April. So that was also a good call for us, and protected our clients, and we made some money on that. But you can see that it's not as bad as one would expect. And looking on a one-year basis, it's even better. There's really, the NASDAQ is well ahead, very positive, 27%. S&P is positive 6%, and the EM is only down -5.7%. So really not reflecting at all the economic slowdown that we're all witnessing all over the world. So one has to ask, what's going on? Why is this the case? And unfortunately, there's no simple answer to this. We as investors have to look forward and not back. And we're posed with a dilemma. Okay, there's the optimistic or the bull case, and there's the pessimistic or the bear case. And both have quite strong arguments, and we need to decide which one is going to be the more compelling. And it's a dilemma. I must share with you that it's a real dilemma. So let's just look at the pessimistic scenario. I think the pessimistic scenario is easy to understand. We all feel it. But the April rebound was a classic bear market rally, which is investment lingo for a sign that weak markets are going to follow. And that was the rebound, and that's it. From now on, it's flat for a good couple of years, or maybe even negative. And we've had all the good news that we're going to have for a while. So maybe that's the case. We got a whole lot of Q1 data, so we know where companies stand Q1, but the real damage is Q2, and that number hasn't yet come in, and it won't come in till end of July. There's a huge economic shock coming, unprecedented quarter-on-quarter drop, and we don't believe, well, the bear case doesn't believe that this unprecedented collapse of economic activity is priced in. Global government support much weaker than the United States. The United States is in an election year. They're throwing all the tools out of the toolbox at the problem, and the unprecedented amount of money is being thrown at the problem. And but the rest of the world is nowhere near that, and nowhere near able to do that. Another pessimistic point of view is because of this government intervention that the dollar will weaken significantly. If the dollar weakens significantly, what will be the impact on the US securities? And of course, the big unknown is, will there be a second wave in the United States, or will there be a lockdown? I'm sure you've seen the virus statistics. There's 1.5 million people confirmed with the virus in the United States. There's some factor on that, on the number of people actually carrying the virus. And when you've got over a million active cases of the virus across the United States, where every state seems to have its own rules, and they're flip-flopping between easing restrictions and putting on more restrictions, then that's not good for business, right? So one has to be a little bit cautious. The harder to understand case is the optimistic case. But these are all valid points. We have low interest rates. Low interest rates mean that there's going to be support for equities. Money, institutional money, high net worth money, people sitting on cash, and there's a lot of cash, will be buying stocks at almost no matter what, because they're not making enough money for whatever their return requirements are in the bond market, and they need to take risks, so they buy equities no matter what. The next point is that the Q2 estimates, the analyst estimates for how bad the company results are going to be, have already been done, and they've already been done with a pessimistic view. So arguably, the market knows about the damage that's coming, arguably. If it's worse than expected, that's a negative surprise, that's bad for the markets, but a lot of that is in the analyst estimates for the second quarter. So, and then again, coming back to the government support that I've mentioned, and from an investment point of view, there's a saying, don't fight the Fed. So don't bet against the United States, don't bet against the Fed. If the Fed is throwing trillions of dollars at a problem, don't bet against it, remain invested in US equities. Fiscal expansion, if there's lower tax or if there's government-financed spending projects, that's good for equities. An accelerated recovery is also another possibility. Maybe this virus ends, just like it has in Israel. It feels like the virus, literally in a week, we went from a much stricter lockdown to, today masks came off, whether it's for the heat or whatever the reason, it feels as if we're over this thing. And it's all of a sudden, and the United States is a bit behind, but sooner or later it'll be over, and then back to business, and there'll be a catch-up element as well. And of course, if this government support is inflationary, and it's a big debate whether it will be or won't be, but if it is inflationary, that's good for equities, and you need to be invested in equities to enjoy the inflation linkage of a real asset like equities. So that leaves us with a big dilemma. And what are we going to do? Then I'm trying to change my slides and it's not going down. So there we go. Okay. Another point that just makes the dilemma harder, and it's come up in a lot of client conversations in the last 2 weeks or so, is the China-US tensions. China will be a central platform issue for the 2020 elections. I think both parties are going to be negative on China, the Republicans worse than the Democrats. But to decouple China from and the USA trading is a lot easier said than done, and it may end up being a lot of political rhetoric. However, there are economically sensitive industries, notably medicine. So I don't think the Americans mind if their headache tablets are made in China, but they will mind if any sort of critical medicines are made in China. So that's one area. And the Americans are very, very sensitive about American-sourced technology finding its way to the Chinese military via Chinese companies. So they're very, very sensitive on this issue, and they're not messing around. And when the US want to deal with a military issue, they're definitely going to put pressure on it. But it's not the whole US-China trade. That is too big and too integrated to decouple, in my opinion. It's just specific industries that are going to be affected. An example of how it would be affected is the US puts sanctions on a non-Chinese company, for example, a chip manufacturer in Taiwan who's selling chips into China to Huawei. And if the US poses, and it's already threatened to do this, to impose sanctions on the Taiwanese chip manufacturer that it cannot sell to Huawei because it's sensitive technology. So those are the type of things that the US can do. I don't think it will affect the big picture, but certainly industries will be affected. So there's no reason not to be invested because of this point. We've always liked China, and we do think it's part of a global portfolio going forward. To wrap this up, what should one do? Remain focused on long-term goals, obviously. There's a lot of research about the importance of strategic asset allocation, and I'm a big believer in strategic asset allocation. One cannot time the markets effectively for a significant part of the portfolio. You can tweak the portfolio a little bit around major events, and that's worked for us this year. But overall, we're underweight risk versus our benchmarks. I think that is the appropriate place to be. We're optimistic for the long term and more cautious for the short term, and that means we're going to gradually increase the risk of our portfolios, but we're in no rush. So it's a matter of months, not weeks. On the bond side, we're fully invested. We think that bonds offer value compared to cash, and they're an important part of the risk management. We're underweight equities versus our benchmarks. That just means we have less than we otherwise would have had, and over time we will fill that equity budget. I really believe that one should not bet against the USA. If anybody watched Warren Buffett's address to his investors 2 weeks ago, you would have seen him said that he said that. New property investments. A lot of our clients are invested in property schemes around the world. I would be very cautious on new property deals. Property takes a little bit longer to sweat through the problem than a stock market. So I would give it time before I jump back in. And the obvious, is for me is look to increase return via alternatives like structured note. Okay, and on that, I'm going to hand over to David, and he can explain what is a structured note. And if any of you have got any questions, please post them on the chat. Thank you very much.
All right, thanks, Mike, and hi everyone, and welcome, and thank you for taking the time this nice afternoon to hear about structured notes, not the most trivial of topics. Let's get right to it. I'll just share my screen. 1 second. All right. Okay, so we named this session Hedging Against Loss of Time, the role of structured notes in long-term portfolios. And I think the best way perhaps to dive into this, other than looking at my personal details. By the way, Mike, it's been 8 years, not 11 years since I left Pioneer. Anyway, I chose to start off with a few sort of long-term equity return charts. This one in particular showing the S&P 500 total return index, meaning with dividends, since basically the beginning of this millennium to the end of 2011. And as you can see, despite the mantra of equities for the long term, this is an example of actually a long-term period where at the end of it, 11-year or so period, or 12 actually, the return is more or less flat for the investor, including dividends. Obviously, we went through two major market crises in between. But that's just one example of even a prolonged investment period in equities doesn't necessarily end up in very positive results. I have a couple of more such slides. This one is European equities. Here, the period is actually almost 15 years. So basically, I started investing in European equities in beginning of this millennium. End of 2015, I'm roughly 20% up, so not very impressive. Annualized, it comes to, I don't know, just above 1.5% per annum, including dividends, and in euro, by the way. So every sort of non-euro investor that invested in European equities since basically 2000 hasn't done much. We have a similar one for emerging markets from 2007 till today, round about flat. And the ugliest of all is the Japanese market. I took the topics index here, but the Nikkei would have looked just the same, which basically shows us that since the bursting of the Japanese equity bubble at the end of the 80s, actually December 89 was the peak, till this day, including dividends, investors are still, still have cumulative minus 20% negative return since December 89, had they invested in Japan. So all of these examples that, of course, I cherry-picked the time periods on purpose, but the point is to show that even, the risk of equities is not just of these drawdowns that we experience every now and then and the occasional crisis, but this could be actually very long periods of equities not delivering anything. And I think when often there are conversations with investors about risk and hedging the portfolio and how and what against should I protect, I think that investors, certainly long-term investors, should care far more about protecting against a lack of return over the long term, as they should be concerned about protecting the portfolio from short-term drawdowns. And that's why we named this presentation Hedging Against Loss of Time, because that's basically a risk that I think is material to any long-term investor, and it is a real risk, as we can see. All right, let's move on. I also looked at rolling returns. So let me just explain this chart. I took this one is for the S&P 500, and I took the same period between 2000 and end of 2011. But every point on this chart represents the cumulative 5-year return on the index. So for example, if you look here at the left end of the chart, around January 2005, which is the first 5-year period in this particular time frame, the cumulative return after 5 years, so meaning an investor that invested in 2000 and 5 years later looked at the investment, that investor would have been roughly flat. And then you can see we have a period that ended with minus 20. We have here a 5-year period that ended at the cumulative return of 120%. That's basically the peak of the market in 2007, and so on and so forth. So you can see that also over shorter periods, you could have periods that end up in nothing. You could have even 5-year periods that turn out or end up, in very negative return. So again, that issue of somehow of being able to avoid or at least mitigate or reduce the probability of experiencing these kinds of investment periods is basically at the core of what we do in Oasis with structured notes. That's the same chart again for the Japanese equities. They call Japan the graveyard of portfolio managers. over the last 30 years, and I think it's very clear why from these couple of charts. So I hope that these few charts helped convey the message of why, of actually what is the risk and the fact that it is real. And the rest of the presentation is about ways to try and cope with that particular risk. And the way we do it is with structured notes. Just to give a basic background on structured products or structured notes, which I'm not sure everyone is familiar with or to what extent. Basically, a structured product is a financial instrument, like a bond, legally, issued by a bank. This means that basically a bank issues a paper, an investment bank, like an HSBC or a JP Morgan or Morgan Stanley or those. They issue a bond-like paper or a debt instrument, which means that they are obligated to meet the terms defined for this particular paper. If you think of a bond, basically a bond is the same sort of mechanism. It's a legal obligation by the bond issuer to repay the principal and some interest over a given period of time. And the terms are preset, and the bond issuer has to comply with those terms. So in the case of a structured notes, it's the same logic. The bank, in this case, issues, you can call it a bond, and has to comply with the terms preset in this bond or note. The difference between a structured note and a regular bond is that the payment terms are not necessarily fixed like you would have in a regular bond. They are typically dependent on the performance of an underlying index. Just okay, just a question, a good one. Where does structured note sit in default waterfall versus regular bond? Okay, so that's a very good question. So basically, structured notes sit pari passu, or the same level as a straight senior unsecured bond would. So the regular Bank of America bond that you would buy, a structured note issued by Bank of America would sit in the same sort of level in Bank of America's capital structure. So it's a senior unsecured debt instrument in terms of its positioning in the capital structure. And I think that question is very relevant because as far as I'm concerned, the number one risk with investing in structured notes is actually the issuer's credit risk. It's not the market risk. If the S&P falls 50% and I lose 50% on my investment, okay, that's a risk and it's painful. But the number one risk related to structured notes is the credit risk of the issuer, the ability of the issuer to actually meet the terms set in the prospectus of the note. And that's why the question on where does it sit in the capital structure is a very relevant one. And I can say just generally that banks today, with respect to their capital structure, are actually in a much, much better position than they were, I think, in generations. And certainly after the, compared to their situation prior to the 2008 financial crisis. So with respect to the credit risk of the banks, it's actually quite low these days. And I think post the recent events and Corona and everything, and the support by the Fed, not just for banks, but just to credit markets in general, I think from a credit perspective, it's probably hasn't been as good as it is for debt holders of banks. Okay, I'll try to, if you can write the questions you have in the Q&A, and I'll try to address them as we go along or at the end. So that's just a general, what is a structured note. Now, typically there are a few types of structured notes. The most common one, and I sort of put it here on a chart, there are two sort of main features. One is the capital protection feature, be it hard protection, meaning that basically your initial investment is protected no matter what the underlying asset does, or a conditional protection, which means that you are protected as long as the index or whatever asset the note is linked to does not fall by a certain amount of percentage. So that's one axis. It's the full protection versus conditional protection. And the other main feature is the payout profile, whether it's an income payout profile, so you receive coupons, it could be guaranteed coupons, it could be conditional coupons, but in any case, it's a predefined return, as opposed to a participation profile, which basically means you're going to get whatever the index does, or 80% of what the index does, whatever it does. So if, let's say, you have a participation note on the S&P 500, and it says that you're going to get 80% of the participation, 80% participation in the performance of the S&P, then if the S&P is up 10%, you're going to get 8 at maturity. If it's up 40%, you're going to get 32%. So what's fixed is the participation rate, but you don't know in advance what you're going to get because that depends on the performance of the index. So these are sort of the main classification criteria for structured notes. And these are, this is the lingo of structured notes, which I'm not going to touch upon too much. We might have come across some of these names like twin wins, etc. These products here, the hard protection with participation, these are the products typically issued by the local banks here in Israel. Very hard to come up with any compelling offering today on these kinds of notes, because basically in order for these type of notes to be attractive, you need high interest rates and low volatility, and we have neither today. So these are not really sort of appealing for this kind of an environment. The other spectrum is these types of products, the reverse convertibles, the memory autocalls, all of these where the capital is protected up until a certain point, and the return profile is some form of a coupon. We in Oasis, we focus mainly on these types of products. We do a little bit of the other types, which I'm not going to go into. And the topic of today's discussion revolves around these types of products, where basically you get some form of a coupon and your capital is protected up until a certain point. If there are any questions to this point, please just write them in the Q&A or chat. I'm going to wait a couple of seconds. Okay, and if not, I'll just move on. All right, if you do have question, again, don't hesitate, just write them there and I'll try to address them later. Okay, this slide, again, the only thing here that I want to focus on is this sentence, which is at the core of our thinking. And basically what we're trying to do when we come, when it comes to investments and investments using structured notes, is rather than predicting the future as to what will happen, and for example, to refer to Mike's presentation, are we heading for the bear case or the bull case? Is the S&P going to go up 10% or 5% or 30%? Which index is going to outperform which? All of these questions, rather than trying to provide answers to these questions, we try to estimate what is the unlikely scenario to happen and express that view. For example, an unlikely scenario could be, we don't estimate that the S&P over the next 5 years is going to drop more than 40 or 50%. So that's a view, it's an investment view, but it's a much narrower view as opposed to trying to predict what will happen. And to give an example, for example, I can think of as an illustration. If I live in Tel Aviv and Pioneer's office is in Herzliya. So you can ask me, okay, how long do you think it will take you to get to Pioneer office? So it depends on the traffic, it depends of time of day, it depends if my car is working properly, what time I woke up, etc. Many factors. And I can say, well, you know, the historic average is around 25 minutes. Now there's more traffic, so maybe it's going to take me 35. Maybe it's going to take me 20 because of the coronavirus, the roads are empty. I actually don't know how much it's going to take me, but what I can say with quite a high degree of confidence is that I know it's unlikely to take me 3 hours to get from my house in Tel Aviv to Pioneer office in Herzliya. So I'm estimating that a 3-hour journey is very unlikely. I'm not guessing if it's going to take me 30 minutes or 40 minutes or 20 or an hour. I'm just saying I don't think it's going to take me 3 hours. Now, obviously, there is a risk that at one day it will take me 3 hours, but the probability of that happening is low. And I need to decide whether I can live with this probability or not. But that's, I think, that explains, I hope, the core thinking of what we do. We're not trying to predict or guess what will happen, more like estimate what is unlikely to happen and invest accordingly. All right, now let's jump to okay, good. So this is an example of a structured note, which we actually traded just as the crisis started evolving. And it's pretty a generic type of income or coupon note. In this particular case, it was issued by Goldman Sachs. So I have the credit risk of Goldman. It's a 6-year note, so its maturity could last up to 6 years. Step down auto call, we'll explain in a second what these fancy words mean. And in terms of the underlying assets that I'm exposed to investing in this note, these are the major sort of global indexes. We have the S&P, the FTSE 100, UK, Euro stocks, which is the Eurozone, and the Swiss index. So basically all the major developed markets. This note pays a conditional coupon of 10% per annum, and we'll review the conditions in a second. It pays it annually with the memory. I'll explain that also in a second. And a 60% knock-in barrier observed maturity, what does it mean? This means that if the worst performing index of these four is down at maturity more than 40% compared to its initial level, the level in this particular case on February 26th, that's the day that the note was issued. If 6 years later, in February 2026, one of these indices is minus 40% or more below February 2020 level, I'm going to get what's called a barrier event, and I'm basically going to get a hit to my capital. Up until this point, my capital is protected. So if the worst index is down 39.99%, I'm going to get my capital back. If it's down 40% or more, I'm going to lose 40% or more, depending on the performance of that index. So this is what a conditional capital protection means. It means that the capital is protected up until a certain point. And we can also see it here visually. And I'll come back to that in a second. Now, what is a step down and coupon and auto call and all of those fancy words? What do they actually mean? So here we have two columns. We have the auto call trigger and we have a coupon trigger. In this case, they happen to be the same. It doesn't necessarily have to be this case, but for sake of simplicity, in this case, both triggers are the same. Now let's start illustrating the payout. Let's say that a year has gone by. We're now at February 2021. All of the indices are higher than their initial level, are at or higher than the initial level, meaning that above 0% return for all of these four. So all of them have to be above. A 10% per annum coupon is paid if all indices are above the coupon trigger. So for a coupon to be paid on the first year, all of the indices have to be above their initial level, and then the coupon is paid. In this case, there's also an auto call. Autocall means automatic early redemption. It's not subject to the issuer's discretion. It's simply a function of the terms and conditions. So in this case, what would happen, let's say that all of the indices are positive next year. The note will be automatically called, meaning the investor would get back the capital, 100% of the capital, plus a 10% coupon. Now, let's say that one of the indices is actually still negative in February 2021. Then nothing happens. The coupon is not paid and there is no autocall, and we move on to the second year. After 2 years, in this case, we review again the performance of the indices. And let's say now, I don't know, the Euro stocks after year 1 was down 10%, and after year 2 was down 4%, 99, compared to its initial level. What would happen in this scenario is that the note would be called because all of the indices are above the -5 threshold, and 2 years of coupons would be paid. So I would get 20%. So let me just repeat that. Let's say that none of the indices is lower than -5, but some of them could be still negative, between 0 to -5. Even in this case, I would get back my capital plus 10% for every year that has gone by, so 20% in total. And this goes on and on until year 6, and you can see that the trigger keeps stepping down every year. That's why it's called a step down autocall, because the autocall trigger steps down 5% every year in this case, and same goes for the coupon trigger. So let's now look at another scenario. Let's say that for the next 4 years, markets remain negative, but at the end of year 4, let's say the worst index, let's now say it's the FTSE, is down 13% after 4 years. So a cumulative return of -13 for the FTSE in 4 years, but it's still above that autocall trigger. Therefore, the note would be called. I will get my capital back 100%, and I will get 4 years of coupons. So 10% times 4, 140 at maturity, when one of the indices is, could still be negative, one or more. So as you can see, this is sort of a payout profile. Doesn't require actually a very positive market environment. It just requires that the market environment is not extremely negative. So even if it's sort of flat or even down, even if we have like a prolonged sideways trading markets with a tendency to go down, we could still make quite a nice return with this kind of a payout profile. But let's say that there was no autocall throughout the period. That's a scenario that markets keep on dropping and dropping and not recovering. And we reached the final year. The note matures. And then we get back 100% of the capital if all the indices are above that 60% or -40% threshold. And if they're above, in this case, -25, we will also get the coupons. We get six coupons of 10%. If one of the indices is down more than 40% at maturity and there was no autocall in between, we're going to get basically the performance of that worst index. I see that there's a question. Let me see. Can the autocall trigger be at any point or just on the anniversary? Okay, so it actually could be any time because we basically design the note. So it's as long as the issuer can manufacture the note based on the specifications that we define, you can define anything you want. So you can have in theory, the autocall trigger every 5 weeks. The sort of the industry norm is typically, quarterly, semi-annually, some annually, depending on the underlying. For more volatile underlyings, I've actually also seen monthly and weekly autocalls, but that's pretty much depends on how we define it. But the norm, as I said, is sort of like quarterly, semi-annually, or annually. And that's one of the sort of factors in deciding how you want to decide, how do you want to, design the note, is do you actually want to increase the likelihood of that note being called early or not? And you can play with these parameters. And that's one of the advantages of structured note, is that you can actually design very carefully the kind of risk return profile that you want to be exposed to. Be it the choice of indices, be it the payout profile, where you set the auto-call triggers, the barriers, etc. It doesn't, barrier, for example, doesn't have to be at -40, it could be at -50, -60. It's just going to impact the coupon, for example, that you see. And this is part of our working process, is to play with these parameters and to see the sensitivities and to come up at the end with what we feel is optimal balance between risk, return, duration, etc. All right, so I hope that the structure of the note is clear. But that's quite a generic type of an auto-call note, and I would say this is the most common profile that we trade in Oasis and traded with Pioneer over the years. Just to, as a side note, we traded till today, I think, close to 300 different notes, all custom or tailor-made. We don't buy the off-the-shelf notes from the banks. We customize or define the parameters ourselves and then run a competitive sort of beauty contest between the different issuers. And as I said, we traded roughly, or issued 300, refused to invest in thousands, and also did some secondary market activity, etc. I'll touch on it maybe later if we have some time. Okay, another question. The structure note is based on 4 indices. If one of the 4 drops below the barrier level, the whole structure note is calculated? Yes. In this case, yes, because this is a worst of note. So you basically linked to the performance of the worst performing index. It doesn't have to be this way. First of all, you don't necessarily have to have 4 indices. You can also have a single index. It's just going to impact the level of coupon that you're going to see. You could do a note on an average of these indices. Again, anything in theory, anything you like. It doesn't have to be worst of. The logic of doing worst of payout profiles with these indices at these levels is as follows. We basically sort of claim that if one of these indices, one of the major global equity indices, is going to be down 40% or more after 5 years, there's a high chance that the others are also down roughly about that or in the neighborhood, because that would imply a global systemic market, prolonged event. But there could be definitely situations where one index is actually really bad performing and the others are, could be flat or even positive, and that's a risk. And again, it's one of the dilemmas of how to construct the structured note, whether you want to be exposed to the worst performing index or not, which indices you include, etc. But again, it doesn't have to be this way. There are advantages and disadvantages. I don't want to go into too much detail here, so I'll leave it at that. The other one, are these priced using simulation technique, historical or Monte Carlo? Okay, these are, I'll just answer that it's based on Monte Carlo, and I'll end it here because I think that's a bit beyond the scope of this particular session. But I see, Greg, I would be happy to share with you some more sort of detailed material if it's of interest. What kind of bid offer spreads you're looking for if you have to sell such a product? Okay, I'll answer that. During the life of the product, what are the drivers for the valuation? Okay, so I'll touch on all of these are sort of mark-to-market and secondary market related questions, which I'll touch upon a bit later. All right, let's move on. This again illustrates just the payout at maturity, assuming we didn't get called. So you can see that other than in the very dire scenario of -40 or worse after 6 years, I'm either protected or even generating positive nice positive return over the period. And put it again in the context of the graphs I've shown in the beginning. Here I'm reducing the risk of being exposed to an investment or sitting years after, for years in an investment that at the end of the day, not getting much or even losing capital. Of course, I have a probability of that happening, but it is far less of a risk compared to a direct investment because I have other mechanisms that can help me mitigate to an extent these types of scenarios. So it's not hedging in the sort of dictionary sense of the word. It doesn't completely eliminate the risk, but it reduces this kind of risks a great deal. And to give the bottom line of this session, this is actually why we believe it's beneficial to include such instruments in a portfolio. Again, it doesn't necessarily substitute, it necessarily doesn't substitute direct equity exposure or other asset classes such as bonds, but its return is driven by some other factors, not just the underlying equity markets. And long term, what it does is it would add some diversification to a portfolio, or would help reduce risk in a portfolio. A lot of investors in these things actually fund their investment by reducing risk elsewhere. So for example, in times like this, some could say, okay, I don't want to be fully exposed to the equity markets, the full downside, etc. I want some degree of protection, but I still want to maintain relatively high potential return with relatively high likelihood. So this kind of an instrument could fit. Some others would say, okay, I don't want to be overly exposed to high yield bonds or some other asset classes or hedge funds, etc. So these are the kind of consideration in the context of an overall portfolio and where does it sit. And I'll touch upon the issues of correlation and behavior, market behavior in a second. Okay, see another question. Let's just see. Okay. All right. So a key question, how likely is being minus 40% below initial level after 6 years? I think it's the perhaps the question in the context of trying to estimate the unlikely. And just to give a bit of a historic context, we took those 4 indices, and just looked at them, over the last 50 years or so, just short of 50 years, 47 years. We had 4 major crises, not including the current one. We had the oil crisis in the 70s, which deeply affected the UK equity market. We had the tech bubble, the financial crisis, and the euro debt crisis, which in a way was an extension of 2008 crisis. And what we looked at is just like a simple calculation of what was the peak to bottom return. What was the return from the peak level just prior to the crisis 6 years later, and what was the 6-year return leading to the bottom of the crisis. So we're taking the lowest level during the crisis and go back 6 years prior and measure the return from that point to the lowest point during the crisis, just to sort of provide some context to returns. So you can see that, for example, in the oil crisis in the 70s, the FTSE had a drop of 71, almost 72%. Actually, it wasn't the FTSE, the MSCI UK, 72% during the period, from May 72 to December 74. But 6 years after, at the end of 6 years from the peak, prior to that 72% drop, the index was actually down on only 5%. If you measure from the bottom backwards, it's much worse in this case. It's almost 61%, and then you see the other numbers. What you can see basically is that we do get major global crises. They're not necessarily very frequent, but they do occur. And it seems that in the last 20 years, they occur more frequently than before. And peak to bottom drops of minus 40% or worse, I think it's a given in almost any major crisis. we came close this time. Maybe we're going to get there at some point, in the near future. I don't know. But over a 6-year period, that's already quite rare to have a prolonged market drop of 40% or more. The type of drops that I showed in these, in the graphs that I showed earlier in the presentation. And if you consider the fact that you have a step-down autocall trigger that basically kicks you out of the investment prior to the 6-year period, again, if certain conditions are met, then a drop of 40% over a 6-year period with that feature in place is very rare. Now let's show you just how rare it is. So we back tested this thing, and basically in 95% of the time, and we looked at each day over the last 47 years and measured the performance had it been initiated on that day. Okay, so we looked at each day over the last 47 years, over 12,000 observations, and in 95% of the cases, the end result would have been a positive return. In 91%, there would have been an early autocall, so we wouldn't get to the final 6th year because the note would have been called earlier. And the split of results in the final year, which is roughly 9% of the total observation, made it to the 6th year. So about 4% would have paid coupons, 4% would have resulted in just getting the capital back, and 0.25% would have resulted in capital loss. So all in all, the probability of a barrier event historically has been extremely unlikely. Now, obviously, history is a good indicator up to a point, and it doesn't mean that that's the actual probability. It's probably higher because there could be events that never happened before and can happen in the future. But if I need to make a judgment call whether this is unlikely, and considering that likelihood, also the return that I can potentially receive and the likelihood of getting that return, that already gives you a sense of how we think about it. And to cut a long story short, for a 10% potential return per annum, the likelihood of risk to capital in our mind is not very high. It's there, it's not zero, but it's worth the risk. And that's okay. I'm gonna skip a few slides. Just to answer that in one sentence, is observed probability a good estimator of future probability? The answer is it's not a bad estimator. It depends also on which assets and how much history you have, etc. But in the context of these major indices, it's a pretty good indicator. Again, not perfect. Let's jump ahead. Okay, now question whether these could be considered alternative investments, and now we sort of dive into the issues of mark-to-market, secondary market behavior, spreads, all of those things. So I don't know, for our overseas listeners, there's a little bit of a joke here. I believe you know this guy, Shimon Peres. In Israel, we tend to have elections quite often, but this is actually from a campaign in 1984 elections, where the Likud party made a bit of a joke of Peres because for everything he was asked, he would say yes and no, like without any definitive answer. So to the question whether structured notes could be considered alternative investments, the answer is yes and no. That's pretty much the point of this. Okay, there are more questions. I'll address them later. All right. So the motivation for alternatives in general in a portfolio, I think we all know, potentially compelling returns, hopefully low correlation to traditional assets like bonds and equities, and low risk. This is the sort of why to go to alternatives. And I just jump ahead. I think a more realistic expectation is that yes, you could perhaps get higher returns. It could possibly, I think there's a typo here, less correlated. And the risks, it's not necessarily lower risk, it's just different risks. And again, it's true to a certain degree to each type of alternative investments, and I'm not going to go into this deeply, but just as a general saying, I consider alternatives not necessarily as hedging a traditional portfolio or behaving, non-correlated to a traditional portfolio. I consider alternatives to be driven by other sort of factors than the traditional components in a portfolio, which means that it could behave differently in certain types of scenarios. That's how at least I view alternative investments in general, and specifically structured notes. Now let's look at the example of the note in question, and this is real example. We got an acid test, if you will, fairly on into the life of this note. And we measure this on March 23rd, March 20th, just before the sort of March bottom, which is, at least for now, is the lowest point during this crisis. And this is the behavior or performance of these different indices over the period of these 4 weeks or so. So most of them were down in the sort of mid to high 20s. The Euro Stoxx is the poorest performance here, down 29% almost. SMI is down 18. We bought the note at a price of 99.10 when it was issued or shortly after. And by March 20th, the price, that's the offer price, was roughly 73. So the note was down it's 26.5% from 99. So first of all, you can see that it took quite a knock in terms of its mark-to-market price, very correlated to the performance of the underlying indices, and in fact, pretty similar in terms of the sort of depth of the drop. And here we can see it also visually. So you can see that the behavior, if you will, behaves like stocks. Now, to put in context, when you invest in structured notes, you're exposed obviously to the performance of the underlying assets. You're also exposed to the volatility of the assets to a certain degree, and some other sort of factors that are related to the issuers, again, which I'm not going to go into. But this, I would say, it's not something we haven't seen before, but it is rather extreme. Typically, these types of notes have roughly 50, 60, 70% sensitivity to the performance of the underlying indices. So for example, if, I don't know, an index would drop 10%, then you could expect this note to be marked down 5, 6, 7%. That's when volatility is fairly normal. What we had in March was a bit extreme in terms of, or not a bit, very extreme in terms of the spike in volatility. And that's how the note was priced by the issuer. Now, as a side comment, these instruments, structured notes, are liquid in the sense that we can sell them back to the issuers, under normal market conditions, even during stressful periods such as we had in March. But the limitation is that you could have only one sort of natural buyer, if you will, the issuer. And that buyer is the one setting the price. So even though typically you could see a spread of 1% bid offer for structured notes, so for example, if that note on March 20th, the offer price was 72.83, so the bid price was 71.83, it was actually the price. So there is a 1% bid offer spread kept, but the question is, but what's the fair value? How does the fair value being calculated? And that's a whole separate discussion about structured notes and the different perspectives of the holder of a structured note and the issuer. But if you will, the fact that I'm dependent on one price provider, one buyer, the fact that I'm able to sell it back to the issuer at any point, given normal market conditions, is one thing. But the fact that I'm subject to one party providing a price, that's perhaps, if you will, the true liquidity of these instruments. They are not very liquid because there is no market price discovery, many deals being done. So I can, look at the recent price of a deal and set the price accordingly. I'm subject to the considerations of the issuers. And there are many considerations in the way that issuers price structured notes on the secondary market that are unrelated to the long-term investment case of the note. And I think I'll leave it here in terms of this. But the result is, at the end of the day, that a month into this note, it was down 28%. Now, that's actually not necessarily so bad. And this, what we did here, we put a bit of a scenario analysis, looking at the levels of the markets or the underlying indices on March 20th. I think I need to step on the pedal here a little bit. What would be the required performance of the worst performing index at that point in order to be auto-called on each of the observations? So from, let's say, when we measured on March 20th, in order for this note to be called in 2021, the worst performing index, which in this case was the Euro Stoxx 50, has to rise 41% almost from that March 20th level in order by February 21, in order for the note to be called. So we could argue that's a fairly unlikely scenario, that we're going to get a 40% recovery from March 20th by February 21st. But if it happens, the note will mature at a price of 110, compared to a 0 performance for the worst index. Okay, here we also put in the chart the total return from March 20th. So if I bought the note that day at a price of 73 and it would mature at a price of 110 in February 21, then my total return would be 51%. And okay, this is also yield 51, 55 or so. And then on we sort of drew the scenarios. Currently, the worst performing index as of today is still the Euro Stoxx 50, but it's down only 18% from strike, which means that it would be, let's say that it remains at this level forever. The note would be called in February 2025, when the index is still down 18%, and the note will pay back 100% of capital plus 50% return. Okay, so this is just a scenario analysis. And when I said that the note being down is actually not so bad, what I meant is that it increases the probability of this note going or taking longer to mature. But given the high level of coupon, that's actually not so bad for me, and especially if it means that markets in general are not performing very well. What we don't want to be is in the scenario that we reach the final year and the note is below the barrier and we have a capital loss, etc. But if it takes a few years of negative markets and at the end of the day I can still auto-call and get my coupons back, that's not necessarily a bad scenario. All right, so this we reviewed. Okay, and I think this is a good time to stop and take some questions. Let's see. So what kind of a bid offer spread? I think I answered. During the life of the product, what are the drivers for the valuation of the product, and does the valuation change as the time passes? So I touched a bit on that. And yes, the valuation does change as you just saw. And what impacts it is, let's say the two major factors are obviously the performance of the underlying assets and also their implied volatilities, meaning that the level of volatilities that is implied by the option models. So the higher the volatility, in this case, it will push the mark-to-model price of the note down further. In March, we experienced significant pickup in volatility, and that was expressed in pricing as you saw. With a step-down auto-call, there is no reason to take shorter-term contract than 6 years. Not necessarily. Just as a sort of rule of thumb, in periods where volatility is very low and markets are running high, I would actually prefer to shorten the maturity and increase the probability of this note being called early for two reasons. One is that I'm concerned that at some point there's going to be a sort of a market sell-off. So my risk of hitting a barrier, we could argue that is higher when markets are very high, valuations are extended, etc., as opposed to investing in such a note after markets had already dropped a considerable amount of points. And the other reason to shorten duration is that when markets are more volatile, as we have now, and volatility is higher, then I can get higher coupons. So if I invest in a period of very low volatility and my coupon is low, I actually don't want to be locked in that investment for a long period of time. I would rather be called early and have the sort of opportunity to reinvest at higher coupons if the market environment provides these opportunities. And in periods of extreme volatility, the opposite applies. I would actually prefer to lock in as long as I can these high coupons and lock this level of high volatility in the markets, as long as I can. So I think that's a factor of choosing the term of the note and how it is designed relative to what kind of market environment we think we're in. But as a rule of thumb, again, that would be my sort of view. How does an investor determine fair value for these notes? Historically, these structured notes for investors have been very expensive without investor even knowing this. Yes, that's excellent. Yes, structured note gained a very negative reputation, and they earned every little shred of that bad reputation. And I think the issue is not so much with the instrument. It's more about the distribution channel of structured notes. Typically, these products have been very sort of like product push kind of thing to retail and high net worth investors. And in the good old days, before my days at least, yes, fees were very high and very opaque and not transparent to the investors. Things have changed quite a bit since, not entirely. You could still see in certain places, South Africa, by the way, being one of them, some notes which are not necessarily cheap and with fees that are not necessarily fully transparent. But in other jurisdictions, again, depending on the regulation, in Switzerland, for example, issuers are obliged to disclose the fees in the term sheet, etc. In terms of investor being able to determine fair value, for these kinds of notes, autocall, I don't think that the average investor can actually determine fair value. You need a sophisticated pricing models to determine value. And because these models also differ from one another, both in how they are designed and also in terms of their inputs, you often get different results. There's no one sort of a textbook solution to an autocall note. What is its fair value? Relating to your previous question about Monte Carlo simulation, then again, it depends on which inputs you feed into that simulator, amongst other things. So it's very difficult for even for professional investors, if they don't have the right tools to determine fair value and don't have the experience and they don't deal with it on a day-to-day basis, it's very difficult to determine. And by the way, sometimes for the issuers as well, they often make mistakes in terms of how they value these notes, not necessarily to their benefit. Sometimes there are situations where these notes are mispriced in the benefit of the investor, not necessarily the issuer. But this is part of what we do is exactly that. We have the tools to determine and at least test the pricings of the issuers and see if the value makes sense or not, compare between issuers, etc., etc. And also, and that leads to, I think, the final part of this session, which I'll try to keep as short as possible, is how to actually to invest in structured notes. And typically we have various ways of investing in structured notes. One of them, we work with Pioneer and the likes of Pioneer, and basically design standalone notes for Pioneer. And that would be a process of understanding Pioneer's asset allocation views, etc., and coming with a note that fits the views and asset allocation needs of Pioneer, for example. And when a note is designed, what's called reverse inquiry, when the investor defines the profile in terms of the note, and we go about and to the issuers and ask them to price it and run a competitive bidding, if you will, then you end up with notes that are not necessarily very expensive. It's not a S&P 500 ETF at 5 bips. There are obviously some costs because it's customized, it's over the counter, it's involves derivatives, etc. But typically the costs are not that high. Actually, if you compare it to other sort of investment instruments over the life of the investment. Again, it could be a few, tens of bips per annum, sometimes even less. So that's the question. We also, what we do is we manage structured note portfolios and certificates and funds, whereby we charge a management fee from the investors and we don't build any distribution fee in the notes. So that basically keeps these notes very cheap, very competitive compared to anything else. And the cost is obviously fully transparent and fixed. So that's how we go about it. But yes, the reputation of structured notes, you could easily buy a structured note which is overpriced and poorly designed. It's not that hard to, and from the most reputable private banks, etc. It's not that difficult to end up with something which is mediocre at best. All right. I think with that, we'll just sort of wrap things up. So as I mentioned, we have a few alternatives. One of them is basically a certificate of structured notes, which is basically a portfolio of the type of notes that I showed you, roughly 10 or 15 notes, and we basically manage them actively. Sometimes sell out of a note if we need to. We try not to do so very much. We diversify the credit risk, the underlying assets, the profile, etc. And basically in one line in your portfolio, you get diversification across 10 or 15. And I think, for anyone who's interested, Mike and the team could provide some more details. I don't want to go to be overly sales oriented in this session. So I think I'll leave it at that.
Okay, thanks, David. We've gone over on time, but there's just two questions here I want to address. One that says, do the indexes chosen cover the whole market or only incorporate selected sectors? The answer is both. We do notes. We generally do notes that cover whole market, like S&P 500. And recently, we're doing a note that focuses on sectors using similar mechanism that David described earlier. The other question came much earlier on regarding bonds. The question was, what sort of bonds are most desirable for A, short to medium term and more liquid, and B, longer term, and what sort of yields can one expect? So the shorter the term, the shorter the outlook, the less risk you can take. So typical investment grade bonds, the yields there were very attractive in early April. They've come down a bit, but still, conservative bond portfolio, you can still get around 3% without too much risk. The longer term, you can take more, you take different risks, high yield bonds, subordinated credit, emerging market, etc. And there we're seeing much more attractive returns. For example, high yield, I think right now is between 7 and 9%, maybe 7 and 8%. So obviously it comes with more risk, but at least you're getting an attractive yield to compensate for one of those issuers hitting the wall along the way. But it's a risk-reward trade-off, and we're happy to have that discussion in more detail. Okay, so thank you, everyone. Really appreciate the time. Hope you enjoyed. Feel free to give us feedback or comments or complaints or criticism so we can learn and improve. And thank you very much. That's it. Yardena, you can close. Thank you very much.
Thank you.
Bye-bye.